Good morning, everyone. Thanks for your patience with a little feed loop keeps us on our toes. I'm Alex Rizzi, and I'm a senior director at the Center for Financial Inclusion. Just to make sure that you all on feed loop can hear us, as there were a couple of people who just had a little trouble connecting. Just putting this screen up so folks know where to click to join the audio. And there are 2 steps here. And so we hope, I know you're all feed loop pros by now, but today we hope that you'll continue to post comments and questions throughout the session in the chat, and our wonderful panel we'll try to answer those questions, as many as we can, later in the session. And we also have a couple of polls today. So the way to do that is you should see a button that says engage. And you just need to click on that. And then once you submit your answer, you can go back to clicking stream so you can see our faces again. So why don't we just kick things off with a poll? So if you all could just press engage, and we want to know what you've been up to in the last week. We have a couple of different activities. So, and I think you can pick as many as you'd like. So I'll give it another second. A lot of Netflix viewers, a lot of Amazon or other purchases, playlist on Spotify, no driverless cars, no digital loans. But yeah, so all of these, we wanted to put this up there because all of these activities in the poll involve predictive algorithms and algorithms that have varying degrees of autonomy that are helping us to make decisions and helping others make decisions about us. About 80% of viewing activity on Netflix is driven by recommendations from algorithms. Resume screening algorithms decide whom we invite for an interview. In medicine, a doctor may not treat 2 patients with similar symptoms with the same course of medicine because an algorithm uses the patient's DNA to recommend different courses of treatment. Dating apps like Tinder use algorithms to create matches. More than a third of purchases that are made on Amazon are made because of recommendations made by an algorithm, like people who bought this also bought that, or people who bought this eventually bought that. In preparing for this webinar, I even read about a patent that Amazon had applied for called anticipatory shipping. And the idea of this is that they anticipate your purchases by boxing and shipping products for you before you even buy it, using an algorithm based on your past purchases and other variables. And those packages wait at fulfillment centers or hubs or on trucks until you click the button and the actual order arrives. And of course, we're moving to a point where algorithms don't just offer decision support to us or to those who are making decisions about us, but they can act autonomously. And driverless cars are a good example of that. And based on what you've all answered here, you're using a lot of them in your day-to-day life. And so when we think about the use of algorithms in the financial inclusion space, there are some really exciting applications, and just a few are listed here. And of course, customer data and data have long been integral in the space, but the real democratization of mobile phones, coupled by data enabling regulatory environments and increased data processing capabilities, have created just incredible opportunities. And as low-income consumers have produced increasing data flows, there are new visibilities for them, for providers to engage, for customers to be reached, and for regulators to do more and create a more enabling environment for financial services. Providers are, and this is happening today already. Providers are conducting credit risk assessments using machine learning techniques that use behavioral data from how you use your phone, device details and call logs, social media information, airtime purchases to provide small credit. Consumers can resolve a problem that they have with a provider through a chatbot. Or in the case of the Bank of the Philippines, there's even a regulatory chatbot. And providers and regulators can use algorithms and those tools to mitigate against fraud or anti-money laundering. A BFA report called some of these applications practical superpowers, and we absolutely see these potential. We see the potential in this uh, for cost savings, for time saving, and increased economic opportunity. But at CFI, we want to engage more deeply and deliberately with the process of how these tools are being developed and deployed with low-income consumers. And we have a broad set of questions that we'd like to explore and answer about how to enable responsible usage of these tools. Questions that range from issues of how to proxy for repayment capacity in the absence of cash flow information or more financial information, to issues around how to avoid further entrenching or excluding populations or societal biases through these new technologies. And this session today that we have this wonderful panel is largely focused around the issue of bias. And like the use of data in financial inclusion, bias is also nothing new. But when you think about algorithms and their scale, they also have the potential to perpetuate bias at a greater scale. If you think about the harm that a biased loan officer could do versus an algorithm that looks at hundreds of thousands of individuals as potential borrowers, the difference is pretty clear. But of course, algorithms are not automatically biased. And in some ways, if you think about it, correcting the bias in an algorithm or that system it appears it could be easier than correcting a deep-seated implicit human bias in a loan officer. So when you have when you don't have data on what you want to measure for individuals like income, a lot of these systems are relying on proxies. So if you don't have income, but you have the make and model of a cell phone, you have time spent online and top up payments, you could use these to proxy for income and make a prediction on their ability to repay. But this can get problematic. There was some research that was conducted on consumers that use Wayfair, which is an online e-commerce website, that showed 5 basic digital footprint variables could outperform a traditional credit score in determining who would pay back a loan that consumers took out to purchase one of their products. The researchers looked at the borrower's type of computer, a Mac or PC, the type of device that they used, phone, tablet, or computer, the time of day you applied for credit. Borrowing at 3 a.m. was not a good sign. Your email address or domain, Gmail was a better risk than Hotmail. And they looked at whether your name was part of your email address, and names were a good sign, a good predictor. And even though this model outperformed traditional credit score, each of these variables was correlated with one or more protected classes. And in the US, it would likely be illegal, or at least in a legal gray area, to even use these variables, to have a bank use these variables to make loans. And when you think about the what these proxies and the correlations of these proxies could imply in the financial inclusion space around categories and demographics and groups that this community, the financial inclusion community, wants to reach to achieve financial inclusion's goal. Uh, um, uh, it's important, I think, to ask these questions about how these tools are being used, um, and unfortunately, in many markets, where these products and services are being rolled out, the norms and the regulations don't exist to prohibit the inclusion of certain data in algorithms, and it's quite difficult, understandably difficult, to incentivize providers to open up their black boxes. So we're looking at CFI, we're conducting some research to advance our thinking around how different stakeholders in financial inclusion approach the use of algorithms. So these are some of the questions that we're asking, and they're aimed at different stakeholders, whether it's providers, regulatory frameworks, or consumers themselves, and how they think about the decisions made about them using algorithms. And so right now, the data team here at CFI is conducting an exploratory research project to help wrap our heads around and think about a framework for approaching some of these issues, which we hope to build on in the future with more work. And one of the cool things about this space is that it really the issues of data rights, data protection, responsible algorithms, responsible AI connects this work stream to a much wider set of sectors who are also grappling with these issues. No one's cracked this puzzle yet, whether it's healthcare, social justice, and of course, there are omnibus regulatory frameworks like the GDPR that address in part some issues around automated decision making and data rights. But beyond the regulation, there's really been a proliferation of frameworks, AI frameworks that come from different sectors and different stakeholders, whether it's the OECD and more government and multilaterals, societies of data scientists, such as the Fairness, Accountability, and Transparency in Machine Learning, or NGOs and advocacy groups like the Future Society. And even though, at first glance, you might think, these sectors are hugely different, fairness in credit or in financial inclusion is quite different than criminal justice. On the other hand, we found that the use of algorithms and these tools, the use of alternative data, and in supporting decision making, they do raise similar questions regardless of the sector. So we've found a lot of these frameworks quite helpful as well, and are looking for ways to take pieces of them that are relevant for the financial inclusion sector. So taking a step back, this project or this topic is indicative of CFI's new strategic emphasis on data and financial inclusion. And when you hear data and financial inclusion, it's just a huge swath of ideas and potential research questions. But we are really trying to ground ourselves and anchor our lines of inquiry with the consumer as the focal point in terms of both opportunities and risks. And our approach really does support the idea that in order for these two tools to really achieve their financial inclusion potential, they have to be examined for risks, pitfalls, potential consequences, both good and bad, for low-income consumers. And we don't say this to be naysayers or a wet blanket on innovation, but we really feel that this lens is important in an environment where the number of players keeps growing, where the technologies are just racing ahead of traditional guardrails on data protection and regulation. So, and we also, in these inquiries are leveraging the 10 years of experience that CFI has had on consumer protection. And we learned through that work stream as well that it's so important to think about how a range of stakeholders can advance these issues, not put the entire onus on providers, but think about regulators, industry actors, investors, and consumers themselves in terms of exercising their data rights. Assuming they have them in a particular market. And so many of the areas we're interested in exploring are being discussed this week as part of Financial Inclusion Week by us and also other organizations. Today we're speaking about responsible algorithms. Later today we'll be talking with David Medine about data sharing paradigms that go beyond consent. There was a session earlier this week on by Ariadne Platakis from CGAP on how open banking can advance financial inclusion. There's also a podcast where my colleague Alex Kessler interviewed our colleagues at Mix, Chrissy Martin and Marie Valdez, on how data practices can at fintechs can help direct capital towards these organizations. So we hope you'll tune in and listen to all of those. And I think with that, wanted to dive into the topic with our fantastic panel. So we have a great cross-section of perspectives here. Thea Anderson is going to be the moderator, and she's a director at Omidyar Network, doing just really interesting work on issues around data equity. Dillon Gardner is the head of data science at Apollo Agriculture, which is a fintech that works with smallholder farmers in Kenya. Malavika Raghavan is the head of the Future of Finance initiative at Dvara Research in India, and they have just done some really great research and analysis and thinking around the intersection of technology, data, low-income consumers, and financial inclusion. And they've also looked closely at the India Data Protection Bill, which is still in process. And Louis Graham, who is the engagement director at the Busara Center for Behavioral Economics. And Busara is, at least in my research, one of the few places that I've seen that has been doing research with low-income consumers on how they interact and how they think about algorithms and how they react to information about how algorithms are made about them. So there's a really wonderful cross-section of perspectives, and just so excited to have the discussion. So Thea, I'll turn it over to you.
Great, thanks so much. And thank you so much for the invitation to be here today. So before we get into the discussion, just a few words about Omidyar Network, because yes, we are doing quite a bit in this space. So at Omidyar Network, we're a social change venture. We have gone through a reflective process over the past couple of years, and especially in the past year, really identified areas of building on some of the areas that we were focusing on in the past, but also some new areas that we feel that we can have the most impact, all very relevant to the topic we'll explore today. So one of our focus areas is really around reimagining capitalism, and that is very much right now focused here in the US, really looking at how do we address some of the structural challenges at the heart of our economic system to shape a new and inclusive economy, And just really within that, within our investments, because we do both investments through our foundation, but we also do commercial investments, is just how do we ensure that the people in communities who have been historically and systematically marginalized by structural racism, colonialism, and indifference are really at the core of what a new capitalism structure would look like. And in that, we focus on investments in building worker power, building grassroots infrastructure, and really a newer area, even reforming the financial sector. Another area of focus that we're really focused on is around responsible technology, and that's the team that I sit on. And the reason we're focusing on this area, and again, I think it just amplifies a lot of what you were just talking about, is, we recognize that technology continues to evolve faster than the laws and the norms that govern it. So we see our task is to help construct some of the rules and norms that can channel some of the tech towards the collective good. So a lot of what we do, and especially my role, is really think about how do we prioritize robust guardrails. And guardrails can be many different things. It can be regulatory, it can be more ethical, legal, economic, institutional, but really making sure that those who are building that technology and have the power of the technology are subject to meaningful checks and balances. And through that, we're doing quite a bit of work around curbing big tech, the influence, harmful influence, I would say, of big tech, fighting disinformation and dangerous speech. And through that, we're doing a lot of work, especially around encrypted messaging platforms, which again, very direct related to the topic we're talking about today. What are different models for an equitable data economy? Just recognizing that the data pulled from the algorithms is where often the most value can be drawn. And then another area is just around accountability and transparency and in the digital ID systems, and then the surrounding potential harms, but opportunities. So yeah, so quite a few areas I think we'll touch on even later today with the panelists, but let's get started with the panelists. You've already done an introduction, but what I'd like to do is ask them to do a brief introduction of themselves. And while they do that, just respond to an initial question. Have you ever wanted to challenge a decision that an algorithm made for you? If yes, what did you do? How was it resolved? And maybe we'll start with Dillon.
Okay, thank you very much. It's a pleasure to be here. So as I said earlier, I'm the data science at Apollo Agriculture, and a big part of my effort is to assess the creditworthiness of our potential customers. So that's sort of where I come from. And to answer your question, Thea, yeah, I think one of the examples that comes to mind immediately is dealing with the reCAPTCHA that is on websites everywhere. So if you're not familiar, these are the processes that websites have in order to verify that you are in fact human. And I find there's nothing more frustrating than when a machine is telling me that I'm a machine. Another example that I want to share is being denied when I was applying to graduate school. And so I think this is an important example because one of the parts that's so frustrating about such a denial is that it's never clear why or where in the process. So many of these cases, people get so many applications, whether that's for graduate programs or for jobs or wherever, that there's some component is just very algorithmic, whether that's somebody in HR going through resumes, flagging keywords, or an actual automated system. And so as somebody who's making these kinds of applications, when you get a denial, it's frustrating just because you don't know what's going on. I think that's a key part of some of these parts, a key part of some of the challenges we're talking about here today. And also, I think it emphasizes the fact that even when humans are involved, the approach can still be very algorithmic. And so this isn't exclusively a process of machines, but also humans going through algorithmic approaches can lead to serious biases as well.
Thank you for that. Those are great examples. And I think, especially when you do the application process, there's even big, massive scandals, all over the world around some of those issues, which again, are increasing by the day. So no, thank you for raising those. I'm sure a lot of us on this call can relate. Malavika, can I ask the same question of you? Just a quick introduction and just a quick response to the question.
Sure. Hi, everyone. My name is Malavika, as has already been said. I'm a lawyer and I'm an interdisciplinary researcher, and I work in India where my research really focuses on data protection, privacy, inclusion and technology, and coming from a consumer protection lens in finance. And my organization has been looking at these kinds of issues, Dvara research, for the last 10, 12 years now. And in terms of what happened, I think I have a very basic kind of, I don't know what it is, red flagging issue that just happened 2 weeks ago. So it's still a bit close to the bone. My bank basically blocked my debit card because apparently there were no debit activities for the last many months because I'm clearly at home and just doing online transactions maybe. What's interesting is this is over and above our financial regulatory requirements. And I guess it's a kind of anti-fraud measure. You know, she hasn't taken money out in like 5 months or whatever. I don't know what that says about my bank balance. But I think the sad part was the only fix to this was that I had to go to an ATM of my own bank. And I don't live in the same city where I opened that, or I have to go to a branch. And basically, I couldn't do any of that because we're still pretty much in kind of like a partial lockdown in India. So yeah, I mean, in terms of the resolution, in case I have anyone interested, it involved asking my dad, who lives in a different city, to go to the bank branch and talk to the manager. So I don't know, two humans on the loop, basically. And yeah, so this is very, very close to my heart this week.
That's a great example, because we all can sympathize with having, as an adult, having to have one of your parents get into your personal lives. But the other piece too is that I think that also just shows that, you know, potentially when that system was designed, obviously COVID's a whole other piece, but it also didn't design for scenarios where people wouldn't be able to access it. So again, that also goes back to just even business models. So that's a perfect example. Louis, can I ask you for a quick introduction, and also there's already been two amazing examples, but if you could add to that as well, I think that would be great for the discussion. Thank you.
Very high pressure. Hi everyone, my name's Louis. So yeah, as said, I'm an engagement director at Busara. For anyone that doesn't know, the Busara Center for Behavioral Economics, we're a research and advisory firm headquartered in Nairobi, but based in a variety of countries around the world. And we essentially look at human behaviors and try and understand them in a variety of contexts, and then apply these learnings to real world problems. So in terms of my example, it's actually a little bit different from Dillon and Malavika's. It's kind of the other way around. It was a few years ago when I was traveling and my phone was stolen, or I lost my phone, I'm not sure, but without my knowledge. And over the course of a couple of days, someone took my phone or took the SIM card out and made a bunch of phone calls to a premium number that I'm guessing was belonging to their friend. And so when I got home, I had a phone bill of just over £1,000 waiting for me, which was obviously quite a big shock. And why this is relevant is because I was really hoping that this would have been flagged by a fraud detection system. And I was actually quite annoyed with my phone company that they weren't able to do that. So yeah, I made a complaint, and they reduced the amount somewhat, although I didn't get it all back, unfortunately. But I think this is an example of, you know, how useful these things can be as well, and how it can be just as bad when they don't work as you want them to, as when they kind of overstep the mark.
Thank you. That's a great example. It shows that tension of we want it when we want it, but we don't want it when we don't want it. I think we can all empathize with that. So that's a really great example. And I think to take that in consideration for the rest of the discussion as well, about when these things make sense and when they don't, even in our personal lives. All right, I want to ask, and before we get into, I'm going to ask individual questions of each of you, just based around your area of expertise, but just one more question that apply to all three of you is just around, Alex had discussed a little bit in the, at the beginning of this webinar around the OECD principles for AI. And so I just wanted to hear quickly from you all, which ones of those do you think are the most important? And why? And I can go through them quickly as well, if that's useful. Let me start, maybe just start with, go backwards. Maybe start with you, Louis.
Yeah, I think, so it's really hard to tease these apart. I think they're very overlapping, and they're all really, really important. And so in some sense, it's quite arbitrary to choose one and say this is the most important. But, you know, I think the one that jumps out at me is inclusive growth. I think this is something that's an enormously important topic at the moment, in that there's a real worry that a segment of people are going to be left behind as we develop more and more kind of algorithmically based solutions. So people who don't have the data available at the moment, who they don't have this data footprint, they're not getting access to services, which means that as the next round of algorithms gets developed, they're going to be left behind again. And so I think it's really important that there is a focused and concerted effort on making sure that this doesn't happen. Yeah, so I would say inclusive growth. But.
Okay, great. Malavika, from your perspective, and again, completely echoing Louis' point that the point of the principles is that they're very comprehensive and build off each other, but at the same time, just for the purpose of the discussion, just understand from where you sit, what are your priorities within this space? So, of the principles, which ones do you think are the priorities, and do you focus on most within your work?
Yeah, so the one for me that jumped out was really accountability. And I think because I think it takes this from lip service to action. And so I'm really curious to see, now we've known about some of these things for, in some contexts, decades now. How can we move forward to fixing responsibility and creating action around consumer protection when you're digitizing, large scale systems in countries with very, very different types of enforcement regimes. So accountability gets my thumbs up.
Great. Dillon, same question for you.
Thanks. Well, I'm relieved that I'm going to choose a different one. So for me, the one that I think about the most is human-centered values and fairness. The reason why I highlight this is because for me as a practitioner, I often feel like the other ones are tools to help me solve what is not something that I feel comfortable addressing myself. And so I want to use, transparency and explainability, the robustness, security, all of these sorts of things, and then surface those questions up to the broader part of the company or whomever else I'm working to recognize that ultimately I don't want to be making these decisions. I want to be able to expose my uncertainty and get help from other people to ultimately help make the decision about what is it that we think is most important. And for me, that really comes from the human-centered values and fairness.
Thea, I think you're on mute.
Well, I made a really good point when I was on mute for everyone. No, I was just saying, Dillon, thank you so much. That was a great point. I like that structuring thinking between the tools as well, because a lot of times when you look at principles, sometimes they are a mix of those, no matter how important they are. So I think that was useful framing. Dillon, let me stay with you. One of the reasons we really wanted to make sure you're on the panel is to bring in that provider perspective, thinking about these topics. So I have a couple of questions I want to start with you. But with the first one is really maybe an overall framing question about how at Apollo Agriculture today, how do you use algorithms, especially as you mentioned earlier, the more client facing decisions that you're making today? So that's part one of the question. And the other piece is how did this look 12 months ago? How did this look 5 years ago? What has been the evolution to get you where you are today, especially when we talk about algorithms? Because it would have been probably a very different discussion even a couple of years ago.
Yeah, thanks. So at Apollo, the primary way in which we use algorithms for customer facing is around assessing credit for customers. So making decisions about who we can give loans to. And then once we give out a loan, we also have a series of algorithms that help us better understand how our customers are doing throughout the period of the loan, and so that we can provide better support for our existing customers. And these are obviously quite related. But those are sort of, it's useful to have fundamental division for us. As far as how they've changed, Apollo is a very young company, and so 5 years ago we didn't even exist. And so when we started, there was a very concerted effort to recognize the lack of understanding of our customers and the data that we get. We took an approach of giving out a fair number of loans with what we have since started calling lend to learn, which is a recognition that we don't necessarily know how these things will work and who will be able to succeed. And so we give a fair amount of loans with the express intent of trying to be able to approaches that work to assess creditworthiness of our customer base. And so over time, we continue to do that still. And so we've reduced the percentage of our loan portfolio that are done this way, but we always want to recognize that these algorithm developments are hard, things change over time. And so the only way that I'm aware of that we can kind of try to continually improve and not leave behind segments of a potential customer base is by continuing to explore through a Lend to Learn program or something similar. And one area that I sort of want to focus on in particular about how these things have changed over time for us is that as we continue to grow, there are two different ways in which that happens. One is that we're giving out more and more loans over time. And so for us as an agricultural company, there's always significant challenges of understanding from one year to the next, what was the cause of it? And so we see, for example, that one season we might have very good yields and very high prices. And the next season, it's not that way. And so we need to try and disentangle, what's driving repayment for our customers and for the loans that we give out. And so season, when we first started, we only have 1 year of data. It's almost impossible to know what is something that is unique to that year versus something that's robust that we can build on the top. And so that's one of the primary things that we're always wrestling with. And the other thing is as we expand across larger areas of Kenya where we're operating right now, we need to try and continue to develop our algorithms in a way that support a broader subset of people. And so when we first start, when we're operating in a particular area, you might see, for example, that our customer base, have a lot of livestock, and the types of livestock that they have might vary over the regions. And so as we develop our algorithms, we want to try and generalize more. So instead of deciding about these very particular data points that we might be able to collect, but instead sort of learning approaches that allow us to generalize for broader things like wealth, instead of do you own a goat? And so I think those are the major things that we're continuing to try to develop is how do we have algorithms that work well over time and over space.
So thank you for that. I think building on that, and maybe this be a good example to a specific product or again, however you internally structure this, but just thinking it would be great to hear a little bit more about like the specific data sources and just how you access that data as well. And I know Kenya, obviously there's probably more ability to access than maybe in other countries just because of the infrastructure, but just understanding that would be, I think, very useful.
Yeah, so we're always thirsty for more data sources and to experiment with what kinds of data we can collect and how that might improve our business. So we do a lot of broad reach. Big part of it is survey data. So we ask our customers a lot of questions directly. And then we also use a lot of broadly categorized as remote sensing data. So information that we can get about where they live, the kinds of soil on their farm, satellite imagery over their farm, and things like this. And those are the biggest parts of our data. And then we also try and work with outside data providers, so credit bureaus and the like. And what I would say is we always have a strong preference for data that either has a high degree of transparency or that we have a lot of control over. So when we look at data that don't meet those criteria, then we're a little bit at the whims of a data source that we don't know what happens over time. And so as a really concrete example of this, we look at the credit bureau reports that come out of Kenya. And in the past 6 months or so, we started seeing a significant increase in the number of previously reported defaults. It's always very challenging for us in this case because we don't have full control over this data to know, are we seeing something fundamentally different about our customers who are applying, or is the data source itself changing over time? And so that's one axis that I find is to be really useful for us is to really recognize the degree of control and consistency that we have over data, and we have a strong preference for things that we have control over or there's a fair amount of transparency.
Perfect. So again, building on that, maybe heard just mention about data that you most desire linked to transparency and data that you can control. I guess the questions I would have, I mean, again, linked to, what Alex had set up at the beginning of the conversation about potential biases as well in algorithmic data, is from your perspective and within the products that you have on offer, we think about the critical points in the product life cycle. So development, data collection, data processing, algorithm creation. What are points where you see there could a bias, one, could potentially creep in, is one question. And then two, how are you mitigating potentially that bias? We see a lot of examples of reactive questions and control over or biases, especially, from a regulatory perspective. But how do you, as a provider yourself, make sure that those biases aren't there in the first place?
Yeah, so for me, I think the area that I am always the most concerned about with thinking about bias is in the data collection part of the product lifecycle. In data science and machine learning, people always say garbage in, garbage out, which becomes a bit of a cliche. But certainly for us, it's really important for us to think clearly about the data that we're collecting and that we're building on top of, whether that's data that we collect ourselves or that we're getting from other sources. And be a little bit, have some humility about what you can possibly do with this data. I think as a really concrete example of why I focus on this part of the data, a couple of years back I was looking at a data set that was loan data for car loans, and this is in the UK. And one of the things that was amazing is that if you looked at this data set, it suggested that people that did not have jobs repaid at significantly higher rates. And now, my prior, of course, is that it's probably very likely that people who have jobs are going to be better credit risks. But you realize that, of course, what's happening is that you're looking only at the subset of people that had received loans. Because everybody who doesn't receive a loan, you don't know whether or not they would have repaid or not. And so presumably what's happening is the bank that was making the decision about whether or not to fund this loan wouldn't give a loan to somebody that doesn't have a job unless there's something else going on that the bank has information of. This person has a lot of independent wealth or something like that. And so if you're not careful about the kind of data that you're building on top of, you can easily make some pretty egregious mistakes. In some ways, you're actually doing the exact opposite of what you want, and as this extreme example can show. So that's definitely an area where we spend a lot of time at Apollo thinking about, and I have sleepless nights over as well. As far as mitigation, I think we obviously try as much as we can to understand how our models are making decisions. It's not always easy. We try and have monitoring in place so that as we are, when we have a model in production, we're trying to make sure that we're seeing the outcome that we expect and the ranges of outcomes that we expect to make sure things aren't going off the rails. And a good example of that is that, especially when we first started, a model that might be viewed very, very well by sort of traditional performance metrics is just a model that chooses which region we've been operating in that has had the highest repayment rate in the first season. And now we know that that's going to be a pretty poor model. And so thinking about things like this, when we are assessing how our models are doing, we want to try and be proactive to think about what are the failure modes that we might see on the basis of what kind of data we're building on top of, and checking and trying to be as vigilant as possible ahead of time.
Thank you for that. And I have a number of follow-up questions, but I also want to make sure we give everyone a chance to talk about their perspective. But I also, and I apologize for not doing this at the beginning, is that I'm sure everyone participating as well has, potentially different questions that have come up. Please put them in the chat, and we'll definitely have a time at the end to go through some of those questions. So please put them in the chat. Malavika, I'm going to move on to you to really help us understand from a regulator perspective. Now, we understand you're not a regulator, but you obviously work very closely with regulators providing, influence, but then also providing policy guidance, and especially, as you had mentioned at the beginning, consumer protection. So it's really good to understand, building on what what Dillon is saying is, getting very much into the day-to-day specifics, into specific data points, how from a regulator's perspective, do they focus on some of the mitigation? Because we see it a lot of times that the regulations aren't in place, or if they're outdated, it ends up being very reactive, which isn't necessarily beneficial for anyone. So I know you have a lot of experience in that, especially in the context of India. So so my first question for you, I mean, similar to the question for Dillon, is just, and again, specifically in the context of India, is that, what are some of the potential biases, maybe the top two, for example, in the financial inclusion space that, keep you up at night, and is part one of the question. And the second part is, from these potential concerns, what did they look like 5 years ago? Were they the same concerns? Have they evolved? Have they changed? And a little bit why?
Great to be here. And thanks, Dillon, for talking about data quality or collection quality, because actually that, and I did not know you were going to talk about that, but that is, I would say, my number one concern, is the quality of the data impacts the quality of the inference and then the ultimate decision made about a person. And that has implications, for consumers around the world. It also has implications for the stability of a financial system, which is, you can't invite consumers into a financial system unless you know that it's going to be robust, because ultimately we know, depositors at least are often the ones, or the taxpayers are the ones who have to deal with some of the misadventures that happen in financial systems. So I'd say definitely really thinking hard about what is the quality of data, especially in different parts of the world, and whether the same types of inferences or algorithmic models are being used, they're being tailored to regions. I think the other one is kind of incorrect red flagging. I think it's a consequence of, poor data, poor inferences, but I think often you can have incorrect red flagging of certain types of consumers in systems, especially in credit systems maybe, and it's very hard for the consumer to know, and therefore could potentially be suffering the consequences for that for a long time. And these are questions we don't really have answers to regulatory-wise, but we'll talk about that soon. But yeah, those are my two top ones. On the second part of your question about sort of 5 years ago, interestingly, I think this conversation was already happening 5 years ago, but honestly, the debate, at least in India, was very much about about visibility and invisibility of individuals, not so much algorithmic bias, but, the fact that inclusion is not happening because you don't know so much about poorer or marginalized people, and therefore banks don't trust them. So the conversation seemed to be much more about how do you get more data? And then now, hopefully, it's more about how reliable is this data if you do get it. I think 10 years from now, if I had to think about how that would shift, if we manage to solve the data quality problem, I think then the issue will really be things like either sort of deep fakes, what happens if we're seeing all of these kinds of also algorithmically driven kind of frauds that are happening now in India already, especially because we have this huge biometric authentication system. So if you can make a deep fake of somebody's biometrics, what does that mean for inclusion is, I think, one of my kind of more sci-fi ones, but these days they all seem to happen, or just pure financial determinism. So, I think the reason we're all here is we want to let more people into the system, but how can you get some of these inferences wrong and then kind of, stall that process? So that's what I'd worry about in 2030, I guess.
Perfect. I mean, so building on that, obviously, we know there's the current India data protection bill, addresses some of these concerns around algorithmic bias, exclusion, and consent. But building on what you've just said, where are the gaps, and what other frameworks may step in to fill that gap? So I have that question generally, but then I'd also love to hear what that would look like for specific populations as well. How is that? Is it structured where it has different impacts, or recognizes the different impacts around gender, around age, where you are in your stage of your life cycle, these different issues as well?
Yeah, I mean, so maybe I'll just take the general first and then get into the specifics of our law, or the one that we're kind of hoping to pass sometime in the next 3 to 6 months. I think at a general level, I think it's really interesting because a lot of the data that's coming through, at least I can talk about the Indian context, is that you can't have a kind of starting set of assumptions that hold for different types of users. So I think I'm not quite sure how the data scientists are handling that, and I'd love to hear more, Dillon. I know how some people in India are handling it. For instance, the kind of things we talk about when we think about financial inclusion, even just for credit or any other kinds of products, mobile phone data, or kind of identity data, or any kind of additional mobile internet browsing data, and so on. Now, we know gender is an easy one because we have the vocabulary to talk about it in India. We know for a fact that ownership of mobile phones is much dramatically lower. The estimates vary between, the percentages are so vast that I won't even give you kind of numbers because I'm not sure what the real story is. But we know for a fact that ownership of mobile phones is predominantly male, but usage of mobile phones may be across the board. So there already you have, a single instrument, and I understand this is common in other geographies as well. And there may be ways in which you can parse out which user is doing what on a mobile phone. But this is the reality of the situation, right? The other thing that then happens for women, I think, is also the types of tasks that they are allowed to do on their phone. And we have 2 studies on gender and usage of mobile phones going on right now, are restricted either through a kind of social pressure, because the internet is often seen as a place where people do bad things, kind of code for what you might think of, and because it's a predominantly male space. So especially in more rural areas, there's an idea that women shouldn't be using streaming services, for instance. And then there's a separate issue of just task sophistication, because women tend to more have feature phones in India, because that might be a family issue, or they just simply earn less, so they afford cheaper instruments. Then a lot of these higher order tasks, like even just browsing and scrolling, become very difficult to get on the ladder for, because you don't have the peer networks, for instance. So I think just the click stream that generates gives you a very different type of impression of what's going on. And I'm not even beginning to talk about things like caste, which is a really serious issue in India, but we don't really have a vocabulary to talk about that in the financial sector even. We don't have a Fair Credit Reporting Act. We don't, have a horizontal anti-discrimination law. So I guess, not to kind of freak everyone out, but I think there are some serious human consequences, or at least an entrenching of the same model of kind of the financial system, where it generally goes to the haves and generally goes to people who are already good credit. So then the question of inclusion is thrown up. In terms of the specifics of how regulatory, the regulatory side is dealing with this, of course, we've most of the financial inclusion aspects, a lot about, and maybe this is not the conversation for that, but our central bank does have a financial inclusion mandate. They've included a kind of charter for consumer rights, which are most institutions are supposed to adopt. And you have general kind of fair conduct rules for providers, which presumably will apply to any algorithms that they're running in their processes as well. I think the data protection bill is an interesting one because interestingly, it does not have algorithmic articles for, sections which say this is how your algorithms should be built. And I actually think that's right, because ultimately what is an algorithm doing? It is using personal data to make particular inferences. And please correct me if I'm wrong for all the people who build these algorithms, but ultimately it's a decision-making tool, right? It's a mathematical or statistical model that's telling you something about your data. And what we really are looking for is that being held up to the same standards that you would expect of a human doing that? So if a human is discriminating against someone because of their race and caste, classic, and that's just built on kind of, that's the reason why credit is denied. Clearly, computer doing it doesn't suddenly make it more neutral or acceptable. So what our law actually does, to get into the specifics, is it doesn't actually say anything about automated decision making. It doesn't have any specific rights like the EU GDPR does for consumers who are subject to automated processes. What it does do is it defines personal data to include any data that has inferences about you. So it's a much wider concept. It's not just kind of a list of your information, but if any inference is made about you by somebody, that also counts as personal data. So I think that's how you kind of bring algorithms into the loop. It also includes a definition of harm. So when you harm a person as due to the misuse of their data or inadvertent use of their data, that harm can include things like denial of service or withdrawal of unintended withdrawal of a service from someone based on an evaluative decision. So I think they're trying to straddle that kind of, analog, digital, algorithmic, human, space, and they're saying when you're making an evaluative decision, you need to not cause harm, and also surveillance and observation, unwanted observation. So this is the really interesting thing about algorithms, right? Like often we might not know that you are having a really deep profile made of you, and there's a bigger question here, because obviously segmentation is essential to serving a consumer, but at what point do we start drawing the line and say segmentation has become hyper segmentation or profiling? I mean, there are many other things I could go into, but I guess the last thing I will say about the bill is that it does include this general requirement for fair and reasonable processing, which I find really interesting. And I think this has a lot of hope here, because I think in this broader technical conversation about what is fairness and reasonableness, our Supreme Court, in a separate decision on the right to privacy, had said that one thing to take into account is a reasonable expectation of that person. When you're doing your data collection, really thinking about the relationship that you have with the consumer, and what is the reasonable expectation they have regarding what types of data you're collecting for the service you're providing. I think that automatically tracks in a lot of the classic data protection principles, like purpose limitation or use limitation and so on. So I think that's one way to approach it at the highest level, really thinking as a provider, what is the reasonable expectation from a consumer when they are giving me data about their loan? Is it that I'll use it to, develop a third product that they don't know about and may not serve them? It's kind of a litmus test, and get a bit more granular on that. But yeah, the headline there is it's more about how we use the data as opposed to policing algorithms at this stage. And that's probably, I think, about right, given where we are in relation to understanding the auditability of algorithms themselves.
Perfect. Thank you for that. Just building on that, one more question for you before we move to Louis. Then a lot of what you said is I don't think a lot of questions in the chat, but then also I have a couple, but I want to don't want to give you too many questions at once. But I think just building on what you're just saying, I think is it'd be great to understand is how should financial providers be thinking of their roles as data fiduciaries in this very data intensive, algorithm driven financial service models? And obviously you've walked us through what's happening in India with regulations, and that was really useful. But what does that mean for some of these quote unquote business models that are appearing very rapidly around some of the data?
Yeah. So you mean like financial providers more broadly as fiduciaries when they're handling personal data and applying algorithms to them in that sense, or very specific types of big techs? I think, okay, I'm just going to go for it because I can't hear you, Thea. So I think broadly, just to answer that as I see it, so if we start thinking about reasonable expectations, because there's a lot of great principles-based thinking for this in regulatory regimes around the world. So I think that's a good way to start thinking about it, that also lets providers to get on with their job without waiting for the regulations to come. So my concern is every time you have a regulation, it becomes a compliance exercise. And we know with data protection that compliance is not good enough, right? Because it's really about what happens when the genie is out of the bottle. And so ex ante measures, I think, are so much more important for consumers than you can't really give them damages once they have had their identities, compromised or something like this, or their social welfare benefits siphoned to another bank account, some of which is happening, right now. So at that point, I think, so some principles, again, I'm really lucky because I'm just telling you what our Supreme Court came up with, still at the principles level. So I would say we need to really make these more granular. There is a sense that you can run a set of tests about lawfulness, necessity, and proportionality. So one is this lawful activity when you're using personal data? And then necessity is really an interesting one for algorithms because it says, if you're undertaking a lawful specified purpose and you're kind of processing data for that, is it necessary and is it using the least intrusive means possible? And I often find this is probably the place where there's going to be most pushback from the developer or the product community because that's simply not the way it is right now. I think if there is more and more intrusive and in relation to the specified purpose, that might need some the way that we currently do data science. And then lastly, this idea of proportionate, is your data collection usage proportionate to the objective seeking to be achieved? And is it causing harm? And is that harm itself proportionate? So again, a very quick story for some of you who may be interested. In India, the big question that came up for algorithms is our identity system, Aadhaar, has a matching algorithm and a deduplication algorithm, which in our Supreme Court, these were, the subject of a Supreme Court constitutional hearing. And the idea was, what do you do when, a matching algorithm or a deduplication algorithm misfires and gets someone out of the system? Right. And I think over here, it's things like proportionality and really thinking about if you're using a system. And interestingly, there, it was really a very consequentialist argument, right? Like there are 99%, there's a match rate, but there's a 1% or 0.2% match rate. What happens to 0.2% of Indians who don't get their welfare as a consequence? And it's India, so it could be 2 million people, right? And really, you're doing a trade-off between your right to receive welfare and infringement of privacy because, there's a privacy harm. And I think that was a really tough one for the country to get through. We landed on the side of having to have safeguards. You have exclusion, but we still have to go ahead with the welfare system that's digitized using algorithms. But I think that's why the conversation is really, what are the safeguards and how do you make those safeguards accountable? Because it's very nice to say, we'll have a great grievance redress process. But when 2 million people turn up and say, how is a state capacity going to deal with that? But that's a broader question, I think, but definitely something at a provider level, I'm sure you face all the time as well.
Perfect, thank you. And again, I think, please remember, for questions that are coming up, please put them in the chat, so we'll definitely have time to come back. Louis, I want to move on to you. We've heard a bit about the provider perspective from Dillon, from Apollo Agriculture. We've just heard about the regulatory perspective, and again, specifically from the India perspective, but I think we all look to India so often to learn what's happening in India, and a lot of countries use India as a template. So I think it's always great to understand what's happening and what's not happening and what should be happening. So Louis, from you're providing input as the engagement director for Busara to really doing customer level research on this topic. So I'd love to hear a little bit about with the research that you're doing, how does your research potentially shed light on how some of the customers of these providers, how do they really understand algorithms that make decisions about them? So that's one question. And then also, just again, from what you're hearing, talk a little bit more about the trade-off between the transparency in terms of data rights, but then also potentially people who are using algorithms even to their advantage as well. And just really, what is that trade-off?
Yeah, thanks for the question. So I think, first, just to define this problem a little bit more, and what is transparency and gameability, and how does gameability affect machine learning and decision making? This is a really interesting problem that we've been looking into a little bit lately. And the basic idea is, these machine learning models, these credit scoring models, they use people's behavior to predict something about them. So they use their behavior to predict creditworthiness, likelihood of getting into car accidents, to base insurance premiums on, and things like that. The issue is, if people start to understand these models and they start to get a fuzzy or an exact idea of how these models work, they can start to adapt their behaviors in ways to try and improve the outcomes that they get. So to try and get a smaller insurance premium, or to try and increase their loan threshold, or just become creditworthy. This can be a good thing at times. So for example, if people change their behaviors in ways like they take an advanced driving class, or they deliberately avoid going into debt and they try not to have risky financial behaviors, that's probably like a good thing. And they've actually changed their behavior in a way that does make them more creditworthy, or does make it less likely that they will have a crash. Sorry, I just wanted to check that I can still be heard, because I was just seeing my internet's unstable.
Yes, we can hear you.
Okay, perfect. Sorry, I think there might be a bit of a lag, but let me continue. Yeah, so this can be good. It can reflect real underlying changes in behavior that are important signals. But it can also just be a case where people are tricking the system, and there's no actual underlying case to the things that should determine whether someone's creditworthy or not. So like some examples of this are, so M-Shwari, which for people that don't know is a digital loan in Kenya offered by Safaricom through M-Pesa in partnership with NCBA Bank. A while back, if you Googled Mshwari, the second thing that came up was, how do I increase my Mshwari limit? And if you clicked on that, it was people going through a bunch of like tips and tricks for how you can increase the amount that Mshwari will give you. So one example is get a friend and send money back and forth between the two of you. And if you send money on M-Pesa below 200 shillings, there's no charge. So you can just send money backwards and forwards over the space of an hour, and you've drastically increased a variable on you, which is how much have you transacted on M-Pesa within the last day. And that will increase your creditworthiness, but it doesn't really reflect anything underlying about you. This is also a huge issue for digital lenders like Branch and Tala, who base this off phone data, which is quite easily like gamed. And so the way the industry normally deals with this is basically by keeping their models a secret, trying not to let people understand them, and then iterating every so often. So every 2 months, when you can see that people have started to guess what your model is, you iterate and change. And I can't speak for Apollo Agriculture here, but I know that there are a lot of providers that do this. This is a really big issue because there's a big shift to having people understand how decisions are made on them. So there's a big move for transparency and forcing providers to be transparent about their models. But in that case, these models no longer work, because if people know exactly how they work, they can just change their behavior. So it becomes a real issue. So the work that we've been doing is trying to see, like, is this a false trade-off? Can you come up with models that are both transparent, that you can tell everyone exactly how they work, but they're also not gameable? And so we were implementing partners on a study by Daniel Bjorkegren, Joshua Blumenstock, and Samsung Knight, who are at Brown and Berkeley universities in the States. There's a paper on this that's out called Manipulation-Proof Machine Learning, which I'd encourage anyone to read because it's really, really interesting. And yeah, the main question of this is, can you build a transparent but non-gameable model? And the basic way that they did this was take advantage of the fact that gaming isn't like a cost-free exercise. It can be financial costly. So if you wanted to send transactions over 1,000 shillings in M-Pesa, that actually costs you money. So that's like a real tangible cost. It can be like physically costly in terms of time. So if you have a variable about how much people move around, that is quite like difficult to actually game. It can also be quite like cognitively costly. So I think one of the things that we found was people find it very easy to increase like their average call length or their number of calls if they think that that's something that's going to increase their loan limit. But they're very bad at doing something like increasing the standard deviation of their call length, because that's just a little bit harder to understand. And so, yeah, effectively, what the authors did and what we did with them was to build a model that takes these into account deliberately and basically penalizes things that are easily gamed. And so the more easy something is to game, the less important it is in your model. And so we tested this in Kenya as well. So we basically, we worked with about 1,000 research participants. We downloaded an app onto their phone, which kind of mimicked some of these digital credit apps like Branch and Tala and others that you're seeing in the market nowadays. And it scraped all the data on people's phones. And then we measured the cost of how difficult it was for them to game things like the number of calls, the number of mobile money transactions, if you call your mother, which is often found to be quite a predictive variable for credit, etc. And then we incorporated this in the model and tested it, and we found that this was a really effective way to increase the accuracy of this model and to avoid gaming. And it was a very stable model that people weren't constantly trying to fight with because it was incentive compatible for them. So I guess the takeaway for this is, yeah, you can build models which are transparent and not gameable. And then this trade-off between I want my model to work, so I can't be transparent, that trade-off kind of disappears. It's worth noting, it's not a panacea. This is worse than like a normal model if no one's trying to game it. But there is a way that, you know, you could have this regulatory push for transparency and then providers can react at the same time. Yeah, so that was the work we did, which we found really interesting.
Thank you for that. I mean, building on that, I think you definitely just walked through tools that you're using. One of the other questions I would have is, I assume, a lot of your clients are their financial providers or donors looking to understand this space, but also, when you are directly talking with potential consumers, what would be the research questions that would be most interesting to them as well when you're talking about this broader financial inclusion sector and automated decision making and bias? So maybe what would be some of the questions that you're asking now, but what are some of the questions that you think you will need to be pivoting to asking to, in 6 months from now and for 12 months from now, as everything is evolving, and obviously in Kenya, it's evolving faster probably than anywhere else?
Yeah, I think one really big question, especially from a regulated perspective, is kind of whether people care. And so do people care? Should they care as well? And then if they don't care, like, is it a duty to increase people and how much they're actually bothered about how their data is being used? I think in terms of algorithms, people aren't really there yet to start questioning how is this algorithm working. There is certainly something around data. We've done a lot of work on data privacy and how much people are actually concerned about how their data is scraped, how it's stored, whether it's anonymized, how it's shared, how it's used, these kind of things. Found some very interesting results that there's basically a bimodal divide, and there's a lot of people who really, really care, and a lot of people who just don't care at all. And this is to the extent that they would be willing to pay a higher interest rates in order for you not to share their data with certain other organizations and for you to share their data anonymously. And other people just say, use my data as you want, I really, really don't care. So I think it's really interesting to understand this and to look at this for algorithms in particular. Because then if you do decide that this is then a really important issue and it's something that we should be trying to say, like, how can we increase consumer caring and consumer knowledge about this? There's a whole question of how do you package something that's as complex as the algorithms that people are using, and how do you make people actually understand this? And this is both a matter of, like, should we be using different models? So should we be moving away from black box models, which are difficult enough for the people who actually make them to understand, let alone the people on the ground? And then also, like, how do we communicate this? How do we package this and let people know this is why a decision was made on you? But I think that's one really, really important question. Another one that I think is kind of coming up is, how do we start people on the journey? I think there's a huge push for all of these people that are excluded and don't have a data trail. How can we start that with them? And how do we avoid missing, like, whole segments? So there's a lot of people looking into, and a lot of providers, especially because they're looking for new kind of credit models that they can use. Who are looking into how small and medium enterprises and micro enterprises as well, like, what data trails they have. Lots of the banks are starting to create various business systems where the primary goal of those is just data and lending. So I think that's a really interesting question. It's like, how do we make sure that people aren't left behind on this one? And then the final one is, like, where the benefits lie. So I think a lot of what we're talking about is, how do we help customers avoid the difficulties, and how does consumer protection work there? But there's another question in how do you leverage the benefits? And I think portability in particular is a really interesting issue that hasn't really been explored as much as I'd like. But how do you make people savvy enough to know that, your data which you're giving to these people is actually a really good way for you to be able to access credit or a new good or a new service that you wouldn't be able to otherwise. And so here's how you go about and do it. And I think that one, it's not there yet, but I think in 5 years' time, that's going to be a really, really key question.
So I want to be conscious of time. I want to, there's been a couple of questions that have come in from the chat. So I'm going to start with you and just kind of go backwards. One of the questions is around perspective on gender bias specifically. So if you could talk a little bit about that from your perspective, from Busara, and how you think about gender. So that's one part of the gender question. Maybe if you could start there, and then I have a second part, and then we'll go back to the other panelists as well.
Really sorry, I just dropped out for a second there. Could you repeat that?
Oh, no, it's no problem. So I'm just looking at some of the questions that are coming up in the chat. And one of the panelists is specifically asking about you and the other panelists as well, perspective on gender bias specifically. So it'd be great to understand a little bit how you view this, how you're tackling it. So that's a general question, but then I also have a more specific question on gender as well. But if you could maybe just tell us how at Busara, how you think about that.
Absolutely. I think probably Dillon and Malavika can speak to this a lot better than I can, because this is something that they'll be dealing with every day. I think this just comes down to what Alex said at the start. Like, you can obviously remove gender as a feature, but then you can take 5 variables and they'll pretty much be able to identify gender, and therefore, like, that doesn't really achieve anything. So I think the question that I've seen in the industry, and this isn't something that Busara has worked in that much yet, but we're pushing towards, is how can you actually model gender in a way that then means that outcomes are fairer? So can you, for example, have different credit scores for men and women and have different thresholds on what extent, like how much of a portfolio of lending should go to men and should go to women? Like, it's quite a crude, brutal approach to do it, but it's one way that overcomes this problem of you can take gender out as a variable, but other things will just proxy for it.
Okay, and so the second part of the question, which I'm going to go back to you on this as well, is that, often generally, but I would say a lot in the financial inclusion space, gender is used as code to refer to women, right? But we know women are not a homogenous group. In experience, financial gender gap, financial services in very diverse ways, right? So when we think about like the broader intersectionality, we think about how do you think about gender alongside age, class, ethnicity, religion, sexual orientation, other different social markers. So it seems like you've already started that piece of the conversation with how you're thinking about that. But I mean, again, not if we think about not how gender is sometimes defined today as just man, woman, what would that look like moving forward in the work that you're doing? And it sounds like you've already started that.
Yeah, I mean, I think that's a really, really good and very, very tough question. The more you deal with intersectionality and intersectional groups, the smaller these groups become, and the more difficult it is to kind of treat each group separately. And yeah, it's definitely a very difficult problem to deal with. I think I'd love to hear what Dillon and Malavika have to say on this, because they probably have a much better answer than me. But I think, yeah, it's important to look into these. It's important to look into segment by multiple variables at the same time. It's important to think about how you can then model these simultaneously. And I think there's some work now in like explicitly modeling these variables in conjunction to try and kind of achieve a fairer outcome. Because it's exactly the same problem. If we're seeing that, it's women in rural areas who don't have access to a phone or have access to a household phone, they're ones that tend to be excluded, then these things can still be proxied quite easily from a set of variables like urban, rural, and owns a phone, for example, which aren't explicitly about gender. So the question is like, how do you identify these and how do you model them?
Okay, perfect. Thank you. Malavika, you mentioned it. You started the topic a little bit when you were talking. Do you have, is there anything else that you wanted to say around this topic? Again, just knowing where you sit within this conversation and the insights that you have, is there anything that you'd like to add?
Yeah, sure. I guess just on this point about what we do when there are so many interacting kind of vectors of discrimination happening, right? I mean, I say discrimination, I just mean like identities. And that's very much the case. So obviously a rural woman who is a Dalit in India will have a much time than someone like me. And obviously, and then of course, that doesn't, we would both fall, we're both Indian women. And so then how do you ensure that you're not using some kind of brute force like hard coding, if X then Y type of algorithms? And the good thing is I think there's a bit of sophistication there in data science, and I'll let Dillon deal with that. And I think there are some good ways that those are developing, but from a regulatory perspective, and I think this is where actually having a broader frame regulator helps, so that you're not actually putting the burden on consumer groups, especially in countries like ours. There aren't it's not a very strong consumer advocacy culture. So I think what a regulator or regulatory system can do is basically assert the broader frame. So I think one of the things about finance and algorithms is that they're happening within a context. And so I think knowing some things about your context help you assess your model more effectively. And I think this came across previously, when Dillon was talking about people who make repayments on cars and when they don't have jobs. I think similarly, what some providers could do is if they're looking at the overall portfolio of their book and they're consistently saying that these types of names, and in India, names are an indicator of caste, right? For instance, these types of names are getting a predominantly type of credit in this area. You can clearly see that there's something happening in your algorithm. So I think there needs to be some kind of assessment happening at the aggregate level. It doesn't need to be at the record level. And what's interesting is I think there's a good analog, like pre-algorithm model for all of this in the US is Fair Credit Reporting Act. Again, I don't sit in the US, but my understanding is that, for instance, you have protected characteristics and you cannot deny credit to someone just because, they're of a particular race. Now, I think the idea of saying, therefore, we'll just blank race doesn't really help, because then you have this proxy problem. So you can't really just say, my model won't consider X. So then the question is, for the purposes of auditing, can firms be collecting particular types of data and then use that to test their own models? And then hopefully as regulatory capacity develops, then that's kind of what the FTC does, right? Goes in and says, was this a genuine credit decision about this person that was not based on, some kind of pre-existing kind of prejudice, or was this actually just a way of perpetuating particular types of structural inequalities, right? And it's a really difficult decision. I go to conferences every day, or like discussions where I'm told, oh, that's not X operating, it's just statistical discrimination. But I think this is a group, because I think when we're in the business of financial inclusion, I think there's already a commitment to saying that, just because women haven't had income streams in the past doesn't mean they won't have income streams in the future. So there is a certain kind of context within which you're interpreting some of your data. And I think that's where a regulator and accountability models for algorithms, accountability models for credit scoring can have a huge amount of impact. But I'd love to hear kind of how, Dillon, you deal with it when it comes to your own model and you don't have a regulator, for instance.
Okay, Dillon, it's on you. Yeah, thanks for the question.
Yeah, well, let me just begin and say this is a terrifying problem for me. And you're always, I'm always very, very worried about these things. As already been mentioned, it's really hard to know when you have variables that are just proxies for things that you really have no intention of making decisions on. One thing about gender in particular that we notice that I think is a good example of just how complex these sorts of things can be is that from the first season that Apollo operated to the second season, we saw a huge shift in the percentage of men versus women that applied for loans for Apollo. And it's really hard to determine exactly why that is, but our best guess is that changes in Apollo's loan underwriting process, the way in which we go about collecting data and the ordering of the steps, was such that we ended up encouraging, if it's a married couple in our new process, it was more common that the husband would end up applying for the loan instead of the woman. And so it's just an example where so much of farming activity, which is what we operate with, are really sort of family endeavors, and in many of the areas in which we operate, the women are often the ones who are doing the primary labor on the farm, and so in many cases it's their decisions that dictate the success or failure of a particular loan. And yet we saw a significant shift in who was sort of the applicant. And so I think these are the kinds of things that make it so challenging when you delve into some of these problems, is that you realize that even when you're doing something as simple as looking at the gender of an applicant, the complexity to that story is immense. And then when you talk about things like intersectionality in different groups, that for us, one of the other challenges there is that you see significant overlaps between linguistic or tribal groups and geography. And as an agricultural company, there's of course significant overlaps between geography and agricultural outcomes, local prices, things like this. So it very rapidly spirals into a challenge of like, how do you really disentangle what you're deciding on, even if you think what you're doing is things that are so closely related to the fundamentals of your product, which is, what are local prices in the area where the products are being sold? What are harvests like? That can still be used as a proxy for anything that varies geographically. So it's a huge problem. And I think this is part of the reason why when in the beginning of this, I was identifying most strongly with this idea of sort of, the human values from the OECD goals, because frankly, I do not feel at all competent to make these decisions. And so I think what's most important for me is to be able to reveal, show, demonstrate where these things are happening, how the actual decisions are happening, what the potential risks are, what the potential ways in which these algorithms may be operating in which we're unhappy with, and then surfacing that up in a way that we can make, whether that's sort of we as a company or we as a society can make decisions about what do we think is appropriate here.
I'm gonna, so thank you for that. And I realize, I think coming in the chat, there's a lot of other questions, and I personally have a lot of other questions as well, but I'm also want to be conscious of time. And we want to close the session with actually a question back to the audience. I mean, just based on everything they're coming to this webinar with, obviously their background and knowledge, but then also what they've heard. So we have one final question, which Alex will put up is, what priority step should the financial inclusion community take on this issue around algorithms and bias? There's 5 options: open up the black boxes, support industry initiatives, develop regulatory supervisory frameworks, wait till we all know how to write code. And then the fifth one is, this isn't even the right question to be asking. And if your answer is number 5, you need to press engage and put in the chat what the right question is. So Alex, I will hand it over to you for the results as people are putting that in.
Great. Okay, yeah, let's see what people vote for. Yeah, so most folks are saying to support industry initiative tools and self-regulation, but 60%, 20% are develop regulatory and supervisory. 25% said wait until we all know how to write code. But I think kind of the interplay and support for both the industry, self-regulation and accountability, but also regulatory and supervisory frameworks, I think, it definitely doesn't have to be mutually exclusive. So yeah, I think we're on time. So this is the conclusion of this. I think we solved it today, guys. No, but just really appreciate everyone's time with these thorny questions that but really important ones that, as we talked about, folks in so many different sectors are grappling with, but we all care deeply about as financial inclusion practitioners who are, working with vulnerable, low-income clients and really want to help use these tools to realize the promise that we have, that we make and we are striving for in financial inclusion. So really appreciate everyone's time and candor and feedback, and thanks to those the questions and the participation on Feedloop. And there'll definitely be a recording of this, and we can also make sure we link to some of the papers and publications I think that were referenced as well by some of the panelists. So thanks so much, and have a great rest of your day or evening, whatever time zone you're in. And yeah, thanks again to everybody, to Thea, to Dillon, Louis, and Malavika.
Thank you so much.
Thank you.
Thank you.